Here we are back again. Oh, 5 minutes later than, no, 12 minutes later than we thought we were gonna be back here, but that's okay. Okay, so would you like to join us? Thank you. And do you want to come up with the treasurer or just cover back?
Got my back. For those who have not met Owen Doherty is our new Ashland. She's moved on to do financial literacy and policy work. He's on day 3. And he's already learned, never give me an original. And he made 2 copies of the briefing book because he knew I'd lose one.
And Ashlyn has moved on in your office?
Yes, she's doing financial literacy, policy, and some special projects. So this is day 3 of the transition. So.
Great.
So I was asked to provide some information.
Thank you.
There you go. I have to, oh, okay, you did take that off. I was wondering if your hand was cold or whether you were injured.
No. It's cold. I broke my wrist
Ooh.
about 10 years ago, but when it gets cold,
Got
it really aches. I forgot the little thing that
Helps you.
it helps me. And John said he did not want to walk around and hold my hand all day.
Okay. Well, you know, in the treasurer's office, we'd be happy to hold your hand, you know, so hey, we're here to help. So, so we were asked to do a kind of a rundown of the valuation and the good parts, the bad parts, and I don't think there are any ugly in there, but this tries to give a summary of the valuations and what it means in terms of next steps as you're considering changes in the pension systems and the benefit structure. So I won't spend a lot of time. Some of these are pieces that were in our July 22 presentation of what's an annual valuation, what does it do? And, you know, our bottom line is that it's that we're trying to calculate the liabilities, look at the value of the assets, calculate the funding status, and determine how much needs to be contributed to get to full funding by the period set by the legislature, which is 2038. And identify gains and losses to assess what's going on in that, and then to retool and reset those with experience studies on a regular basis. Our experience studies by statute were done on a 5-year basis. I'm trying to remember what, I think it was a 3-year basis going forward. I wasn't sure if it was 3 or 2. I do want to point out that when you do evaluation, it is a snapshot at a point in time. The actuaries are not going to be predicting which is hiring steps are going to be down the road. You know, if we've had a high vacancy rate in some positions right now, for instance, corrections, they're not going to be making an estimate of what it would look like, you know, 6 months down the road, one way or the other. So you will see changes in the next valuation based on staffing and the number of active and the number of retired employees. Again, experience studies are to kind of reset those actuarial assumptions. And they are used to provide a way to project future liabilities, but they aren't, while they're used to estimate it, they do not determine outcomes. And the bottom line is it's your real experience, actual experience that makes a difference in terms of where you are. So I updated some of the charts you saw in the 20 valuation in our July 22 presentation. And as you can see, the first one for VSERS, the good news is the funded ratio went up from 66.4 to 67.6. These are rounded. The not so good news is that the unfunded liability continued to rise. Now, it did rise at a more moderate level, but it is an increase. And if you remember, the target was to get back to the levels that existed prior to in the 19th val, and we're not there. And this is moving in a different direction. Again, it has not, you don't have the same experience with the rather drastic in 2020, but it does have an upward trend to it. If you take a look at the next one, I put a graph in there. It's an update of where we were, and you see the bottom line of where we're headed in terms of the unfunded liability by year. If you look in 2007, the state system was in a positive overfunded position. So a negative number of 11,000 and change was a surplus at that point in time. And as you can see, has continued to grow since then. What that does mean, and again, it this is the committee's, the task force determination of where they're going with this. But if you recall, in our report to you, we identified from the Board of Trustees, the desire to take a look at getting back to the numbers in the 2019 valuation in terms of unfunded liability and the ADEC. For the state system, that identified a reduction in the goal, and again, the task force and the the statutory changes made in Act 75 have different language, different points, 25, 50% of these, the targets, but this was the target that folks were looking at. If you take a look now, using the 2021 valuation, as it will impact the 2023 budget, there is an increase in that. So if you were looking to get back to 2019, you've added a little bit more to get there. Same trend in the teacher system. You see the 2021 valuation, and again, there's an increase in the funded ratio, and that's because you have more assets. Your liabilities have gone up, but you have more assets. But at the same time, the unfunded liability has increased, and 52.9 is still a dangerously low place to be. The next chart is the same as in VSERS, which provides you the pattern of unfunded liability by year. And we did start both of these 2007. If you recall, in my July 22nd presentation, I pointed out there was a methodology change in 2006, and it's kind of, so we wanted to not confuse it by having two different methodologies in one chart. The VSTERS challenge, again, that was about a $379 million target in the unfunded liability, and that's now moved up to $396 million. And again, you've set different levels of goals within the task force, but if you were to get to that 100%, this is what it would look like. I'm going to move on. The actual valuation, a key point is gains and losses, and we talked about that again in July. You have economic gains and losses, which are investment return, cost of living, inflation, which is has an impact on salaries, has an impact on investments, and has an impact on the cost of living. The demographics of mortality, salary increases, termination, and retirement. And again, we reset those in 2020, which is a periodic process that reset those assumptions, but we did see a pattern nonetheless of gains and losses. I bring you to the next page, which has in the package that we provided again in July. So a lot of this is update from the July, the June 30th, 2020 val. You'll see that from 2011 to 2020, these are the different areas of changes in versus the assumption. So the actual gains and losses. I want to highlight a couple each in VSERS, the issue of salary experience. Again, this does not mean the salaries are too high, too low. We're not the human resource experts. That's not our job. We're not workforce experts, but we do believe that a more comprehensive workforce project needs to be done in this state. We're not doing it. If you see, the salary continues to be a loss. So negative numbers, the numbers with brackets are lowering the liability, and hence the numbers that are positive are losses. So you see that salary experience in the state system continues to be a loss, but certainly at a lower level. I'm going to go back to some of the others. Net turnover, but the biggest one is retirements. It has not. It's a little more on an annual basis, but I point out that it has been a loss to the system in terms of the assumption going all the way back into 2011. And frankly, before that, if you looked at 2007 moving forward. The big ones that were changes we expected when I testified in July, so that we knew that there would be two significant changes going in opposite direction. One was the COLA. We've had low interest rate environment, and the COLAs are determined based on that, those inflation factors, the CPI. Urban Northeast is the benchmark we use to determine COLAs in the subsequent year. So that has always been or recently has been a gain to the system. This year was a significant loss, $35.5 million. That was a significant negative piece of this year's Val. On the other side, the investments, we had a significant improvement. And so it was a gain of 52 million. I'd like to point out that pretty much obliterates the losses and investments going back to 2011. And I used 2011 because I did not want to include the Great Recession. I think I would call that, knock on wood, an anomaly. And we don't want to ever be there again. But so it's pretty close to even, and you're going to see in the state teachers system that it's actually in a gain position now. So overall, if you go from 2011 to 2021, we're essentially neutral or just a tad over in gains compared to the actuarial assumptions.
Can I ask just one clarification?
Sure.
I'm sorry. I think
please.
I have this right, but I want to make sure. So where you have the parentheses,
Yep,
you said it's essentially a double negative, right? Like,
it's a gain, right? Because what you're doing at the top is, you're identifying where your unfunded liability is and what it made it increase and what the other direction to lower that liability.
so as usually the parentheses are like a loss, this is actually a loss of the lower, you're losing liability, so you're gaining.
Yes,
Okay. Wanted to make sure I had that straight.
simple as can be, right?
Just gotta
Yep.
clarify.
Okay.
Because it seems a little-
No, good question. Yes,
Just
yeah, Andrew.
one question to, the salary experience. Can you, I want to make sure I understand that part again. So here we have it as a loss. Is that because salaries didn't grow as much as expected? Is that when it
That's
results in a
correct.
loss?
That's
So if
correct.
salaries had grown more than expected, it would actually be a gain.
Right. In this case, it's a loss. In the teacher system, it's a significant gain.
Okay,
And again, I'm not gonna
yeah. I just
opine
wanted-
whether those are the right salaries, but it's based on what they see in terms of growth in the economy that's going to have an impact on salaries and where we are in terms of our current salaries and step schedule, and some history on that.
Okay,
So,
thank you for the explanation.
no, thank you. Stop me. I know I'm going at a rather rapid rate, so I'll try to slow down. But if you have questions, just interrupt. And if I'm not seeing you, just yell it out or bang on the table or talk to the chair and we'll get my attention.
Okay, you were
Yes.
going pretty fast. I didn't want to jump in, but since you're
Yeah, you got it.
Since you're inviting it, can we just go back to the scope of the challenge slide? So it looks to me like the ADAC change field, that encompasses the total ADAC change. Now, a portion of that was expected due to the amortization schedule. A
Yes,
portion was unexpected.
yes,
What was reflected here is the total.
yeah.
Is that correct?
The direction that the board had given originally to the treasurer's office was to get back to the ADEC level of 2019 and the unfunded liability of 19 as well. So we're putting in the entire amount, but you're right, there is some growth in that based on the amortization schedule. And if you were to change that amortization schedule, it might lower the ADEC, but it's going to cost the taxpayer a lot more interest. It's like your mortgage at home. You pay it off faster, it costs less. And so that's the what the give and take on that issue. I would not, as a method of reducing funding issues and reducing the ADEC or taking less pressure on that, the goal is to re-amortize. I would not recommend that. On the other hand, if you take a look and you're getting closer to the end of that 2038, so you're at 2035, if a great recession or a similar recession was to hit, as I say that, I think of the consequences, but you would have a real problem paying for all that by 2038. So you might want to talk about that. Those are extreme situations. I think that changing the amortization schedule to accommodate the ADEC is not good policy.
So I would just want to make a comment there. When we think about it as the scope of the challenge,
Mhm.
the increase that was expected, I don't necessarily think as the challenge. So we should keep that in mind, that a certain degree of increase was expected.
Yes. Okay, so I'm gonna go through the VSTRs, so the next page on the VSTRs gains and losses. And again, you see that COLA, which has been a loss, a gain over the years, is now a loss to the system, increasing the unfunded liability. And on the investment side, again, we had significant gains. And those are on a smooth basis, and I'll get to that in a minute. But you'll see that the 57 million more than exceeds the cumulative gains versus the assumption. So we're now in a position of just slightly, and it's minute as a percentage, but just slightly over the gain over the assumption in aggregate between the two systems. Again, you're going to see. I'm sorry. Go for it, Eric.
Yeah, so when I'm looking at this chart, does that include deferred gains, or is this on an actuarial basis?
This is on an actuarial basis.
Thank you.
Yeah. And I have a chart in there that I took right from the actuaries, although I'm working on replicating it and extrapolating into the future years. So I hopefully will be able to give you folks a supplement on that. But I had 24-hour notice that I was going to be doing this, so I'm not quite ready with that chart. You see again, the salary in this case, the salaries did not increase at the level that was assumed. So that is a gain to the system and continues to be a gain. Retirements continue, and net turnover continue to be pretty big events in the loss column. Yes.
On the VSTRs page there, the cumulative says 2011 to 2020. Should that be 2021?
It should be, exactly. My apologies there. We'll fix that.
No problem.
Thank you.
You're so good at finding those little.
No, again, I put this together rather rapidly, so please, and we'll send a updated copy to you. Thank you.
Yes. So in reading this, was there interplay between on the Easter side, the salary experience being net positive in terms of personal liability, retirements being a net gain? Are those higher salaries?
Yeah. It's kind of hard to put a causal, relationship on this. When folks see the retirements going up, is it related to COVID? Is it related to people's fears about retirement? And depending on where you are in the argument, you might think one or the other. I noticed a report recently about teacher retirements and loss of teachers all over the country, and they're not going through this crisis. But again, I wouldn't have the data on that. But unless we interviewed everybody upon retirement and said, "Why are you retiring?" But I think that the gains, the salary is a gain in this system. Whether or not that's a piece of the decision making that someone has in terms of retirement, I don't know. I guess we could do some type of study at some point in time and ask retirees, about their experience in retirement and what some of the reasons are. I don't know what would have to be done to be statistically valid. And Michael's looking at me and saying, we're not doing it now. So, hey, yeah, we're kind of busy right now.
And it's just interesting to see the difference between the state side.
It is.
Where it's both are.
Yeah, it is. And again, I can't, I won't opine on the salaries, whether, you can make an erroneous assumption. The salaries for the state are too high and the salaries for the teachers are too low. That would be an erroneous assumption because again, it's measured against what was expected.
Right. And on the state side, because since there is sort of a discretion to make that assumption.
Yes.
Well, so that's why I assume it's people.
Yeah.
Assume that they're going to be there and work and earn. Years, but then they leave early than that.
Yeah. Yeah. Well, again, if I think that some of this work is related to workforce decision, just as I said, don't make a causal link, I'm going to do one. But you look at the number of people that are retiring and they're higher in terms of their years of service and presumably pay. And then you're bringing in folks that have a lower pay scale at that point in time. So that's probably part of it. I think that some of the issues in the teacher system in terms of turnover, salaries and retirements is directly related to to changes in this, in the workforce and the structure and the pressures on the budgets, frankly, at the local level. And I feel confident in saying that because the real pressure started around 2010 in that discussion. And you see that that's where the trend line begins on this. So again, I can't say, for sure that there's a link between the two, there's a correlation that's real. But I would say that given that anecdotal data, I think there's some relationship there. The next is investments, and this chart you saw as well. It's about 24.6% investment return this year. It's actually a tad higher when you build in, we have some of our private equity and real estate that comes in, with a little bit of lag for quarterly reporting. So we end up having to adjust upwards. So there's a little bit of difference between these numbers and the numbers in the valuation. In addition to that, the actuaries do not have the cash flows. They don't know, what time period, this amount of money came in as a contribution and when the monies went out. So they take a point on those. So there's always a little variation. I remember talking to Steve Klein, he'd say, why are those numbers different than the investment report? So my first answer was, thank you for reading them. And the second was to try to go through those. So, I think the next page is indicative of, well, before we go there, if you look at, you have ups and downs in the market. It's very volatile. You have some years big dips and others that, that are a little more constant, but it's a very volatile environment. So when you say I've got a cushion because I've smoothed the assets and I'm going to have the rest of those over the next 4 years, remember that your investment return could take a very different direction. And it's not, it is cash in the bank. We have the money, but the next piece of it, the projection of that piece in terms of what the investment is going to look like over the next year. Economists involved in this, and again, I apologize for any economists that are here or listening. I made the joke the last time, if you have 3 in the room, you're probably going to have 6 opinions. And in this particular environment, I'd say that that's even more the case. Is this inflation that we're seeing permanent? How does it relate to, to supply chain issues, and how long is that going to go on? The federal government is looking at inflation and how are they going to get in and taper the tapering of bonds, and that had a big impact on the market several years back. It was called the taper tantrum. So the change in policy at the Fed was the taper, and the tantrum was the market response to that. So we don't know. There's some thought. I listened very carefully to our investment advisor yesterday. He may be listening to this, and I did reference you, but they talked about the possibility of what's called stagflation, which is low growth and high inflation. So we don't know where it's going to go. But I would point out that and this came from RVK, our investment advisor, that if you look at the various benchmarks for the market and through the first quarter of our year, the quarter to date, doesn't look good. So as you're looking and saying, I've got all this extra cash, it's going to help me down the road, you have to put it in context of the volatility of the market. You're in a better place certainly than you were a year ago. That's good news. But as you see in the graph, you were in better places as you move on. And if there is a chart that I did not put in here, which is the actual and the market value, and you see that at some points you're above it, and at some points you're below it. And that's the idea of smoothing, and why you do it is so that you don't have the big ups and downs. If you do your ADEC on a market value basis, you're never going to be able to have a clear budget process that you can rely on. Yes, Andrew.
Is the CYP current year to date?
Yes.
Okay.
Yeah. And again, those are great numbers, but where we are can be very unpredictable. I look at the markets. I try not to look every day, and I don't. But especially in my own stuff, I say just leave it alone. But, as I'm looking at this as a fiduciary, I want to look at it a lot more closely than my own things, to be very candid. I have concerns about the uncertainty going forward. I think that our investment advisor explained some of that yesterday as well. And I think the bottom line for me, you can't invest your way out of a pension problem. It's as simple as that. It will help. It's certainly a factor, but you can't rely on investments to solve your problem. The next page, again, yes, sorry, Eric, go for it.
I mean, doesn't that fundamentally go against, the equation that we think of, contributions plus investments?
Yep.
Equal benefits. I mean, shouldn't the investment performance in fact pay for the benefits?
Well, again, we're at a gain now, right? I mean, so minute, but for a while we were on that volatility, we were below that. The assumption that we have, the long-term assumption is 7%. And you're gonna have ups over that and downs over that. And that 7% is a part of the calculation of where we are in terms of our long-term liabilities. And frankly, if you have great performance above or below it, but right now we're right on target to that assumption with that volatility. So I don't think that as it stands right now, that you could say that we're gonna have 6 years of or even that, this is a 30-year trend, but 6, 7, 8, 10 years of boom economy. We did for a period of time. That was a lot of Fed intervention in the market that created that in the interest environment that we had. But you have to look at it on long term. And I think that as you look at that now, one of the comments I made is performance and outcomes are the bottom line. If you can do better than that 7%, that helps. Certainly, but again, you can't look at this as the solution in and of itself. The next chart in here, there's something that you had in July, but I wanted to reemphasize is we're right in there in terms of our 7%. This is data that was done in May by NASRA, the National Association of Retirement Administrators, and the average was 7.13 and the median was 7. So I think we're in the right space. This chart comes right from the actuary, from Siegel's presentation to the retirement boards. And this is a part that I'm going to be replicating and moving forward. I did a projection before we did this, and I think I mentioned the committee would probably be someplace around 50 million, 49 to 50 million at the time. Then we had some increase in our investment. So the model will work. I just need to spend some time with it. But essentially, this is what the process is. So you take the actuarial value of assets from the previous valuation. That's your starting point. And then you have the money that's coming in, includes contributions. It's net money, so it includes contributions, and includes payouts and interest. And I've separated those out, as does the actuary, into different categories, so that what are your net inflows and outflows. Some of that has got to be estimated because you don't know what those employee contributions might be, for instance, or what the cash flows related to them are. So you get a preliminary asset value. Then you take a look at your market value, and you can see our market value was very good. This is the Visas and Visas. I'm looking at Visas right now, but the same pattern. And you get what is the difference between that market value and the presumed asset value based on that formula in terms of inflows and outflows based on your previous actuarial valuation. You have a difference in this case, a gain of 260 million. I should have brought my glasses, but and then you take that over a 5-year period, so 20%, and that's your 52%, 52 million. That's this year, and you can see it's 57 million for the teacher system. I can see Eric's got a question. He's just rearing up for it. So go for it.
No, not yet.
Okay, looking forward to it though. So this process, again, you're going to have 50 million or 57 million as your starting point in the next valuation. But if you're at -4%, at the end of the year or whatever it might be, that's going to dig into that. So again, the assumption that you got a cushion that's going to is going to solve the problem in the subsequent years would be, I'd say, not accurate or not the best assumption that you could make. John, do you have a question? No. Okay. All right. And finally, I just put in here. Yes.
Yeah, I just want to be careful how we describe that, because
Yeah.
a cushion that will solve the problem is different than saying, for the state employee system, we have $209 million of deferred gains. I mean, that's a fact.
Yeah.
If there is a bad year in the future, would offset any of that performance. So in a sense, I mean, it is a very real cushion, the degree to which it
Yeah.
actually impacts the plan out of future
Yeah.
valuations.
My presumption based on those benchmarks for September, and we have a flash report, which doesn't have all the information in it yet, is that there would be some losses at best for the quarter. So right now, you've already got a position where, that cushion has been breached to some extent. Again, we don't see the numbers yet for September, final numbers. There, as I say, we do a flash report, but a lot of that information, particularly real estate and private equity, comes in and lags because it takes them a little while to get those numbers done and into you, as well as private debt. But this is the process. What I'm going to do is try to take this chart, do some cash flows, take a look and see what that does over time with different scenarios. If your investment rate is blank, if your investment rate is this, and try to do that. I did this math behind this and got pretty close to where the actuary is. I want to fine tune it a little bit, then I'll be able to present that to the committee or task force. Keep calling your committee. The last chart, Eric, is exactly what you've been talking about. This is the classic formula, and this that is used in actuarial science here. And I did want to point out that something that we said back in 2005 is that, the critical tipping point is not when the assets run out, but when the governors and the legislatures no longer believe that the required contribution are realistic. And I think that that's a very important point as you move forward. And obviously, this is something the Treasurer's Office has kept in mind for a number of years. I think that I worked on writing that quote, by the way, so hey, that's a deputy. And that's the end of our presentation. I'd be happy to take any questions. I think for me, the good news is that the funded ratio improved. That's something that is helpful. The less good news, or the concern that I have, is you still have some increase in unfunded liabilities. Granted, it moderated, but in terms of solving the current situation, in terms of the goals that you've identified, it adds to the problem, doesn't reduce it. But again, it's at a much more moderated level. And I think that there's some good pieces to this, and there's some cause for concern as well.
So on the investment side, I don't think either one of us would be very good, predicting what the returns are going to be next year. So I'll leave that sort of aside. Although since the close of the last fiscal year, returns have been strong. The numbers in the synopsis do focus on the actuarial value of assets basis.
Yep.
Which obviously don't tell the whole story of the gains we saw last year, because they'll be recognized over time. Could you speak to, and you mentioned the unfunded liability increased. Could you speak to the unfunded liability on a market's value of assets basis?
Okay. I don't have the reports for this year. That's we do have that in the actuarial report. Let me get to that. Hold on. I was about to say we don't have the GAS 67 and 68 reports, which my apologies on that, but let me get to the page. I think it's page, if anyone's pulling it up on the web page, it's around page 9 that you have that. Oh, there we go. So for the this is the teacher system on a market value. Your unfunded liability on a market value is for this teacher system in 2001 is 1,719,000,000 versus 1,950,000,000. Again, I'd be careful, because if you took a look at the prior year, where assets, the actuarial value of assets from it would be about 104% higher than the market value. So you'd have the reverse situation in a prior year, which is why smoothing is part of it, and why we use the AVA, the actuarial value of assets, as your barometer, because again, you're going to have that up and down depending on the volatility of the market. So if you were to look at that number a year ago, you'd have, well, it's right there. So if you take a look at your actuarial value, market value, it was let's see, unfunded liability. Well, even there, I guess it's still there, a little higher. But if you take a look at your market value of assets in your AVA, there's considerable difference as well. So it's going to vary from year to year. And I'd be happy to put together a chart that shows that, if that helps you.
Yeah, I mean, using the actuarial value of assets, I think makes all the sense in the world for budgeting purposes. But I just want to make sure that when we view the health of the plan, I mean, like, funded ratio, you could make the argument that the market value of assets
Sure.
is a better benchmark. That when we look at it as a market value of assets, I just looked at the teachers for the first time. I
Yeah.
hadn't seen that before.
Yeah.
But for the state employee system, it was very similar. The unfunded accrued liability decreased by $300 million in the state employee system.
Yeah.
That's a significant, I think as we view the plan holistically, we want to, we want to
Yeah.
keep that in mind too.
Respectfully, I would say, once you start doing that, it's a little bit of selective data. This is good this year. It's not going to be there. The next year, we're going to use AVA. During the Great Recession, some folks, their solution was to change the smoothing, okay? Because we got a big hit this year, and so I'm going to move it to 10 years smoothing. Like some big pension plans did that. And the result, by the way, was to make it look better. But in the end, when the market started to pick up, you had the snapback. They all wanted to move it back to 5 years instead of 10 years smoothing because they got a better result. I think that when you use it on a market-based basis, again, I think there's an adverse selection in this process, and whether you pick actuarial or market value. And I think that consistently we've been using actuarial value, and I would strongly recommend we keep the focus on that. The answer of we got so much money this year, take a look at that chart that with the graphs, and the performance. You're going to have ups and downs, and the smooth AVA is what we've been doing since the plan started. I can't say in 1947, but I have gone back to 1979, at least in the teacher's plan, tested off the books. But that's the benchmark that we're using. And I think that to select something else in a different year is not, to my mind, the best way to do it.
Yeah, so I agree with that. I don't think you'd be picking and choosing, but I think it's helpful to look at both.
Sure, I appreciate that.
We do use the actual value of assets. So when we're looking at those numbers in that context, it is important, I think, to reflect that we have $209 million deferred gains. You look at that in the context of the total unfunded liability, and that's just for the state employee system. In the context of the $1 billion unfunded liability, that's a significant amount that you don't want to lose track of.
Sure. Any other questions? Madam Chair, I'd like to kind of talk about a different subject and go back to something that we talked about a few meetings back on revenue. And I'd like to kind of have a conversation, if it's okay, about where I think that we should. In the end, this is your call. You are the owner and the creator of the solution. So this is just a perspective that when I look at this and I look at other plans and how to address it, I think that I'd just like to interject a little, recognizing that this is not my call, it is your call. But when I look at solutions, and if you look at our report back in January 2015, and I'm going to go to my revenue letter if I can find that. And what I said in that letter was that as noted, I'm just going to quote it right now. So as noted in the January 15th report, a portion of any available revenues should be directed to paying down the liabilities rather than establishing new programs or existing programs. Pay your debts first. One-time revenues should not be built into the base operating budgets. One-time revenues can be used to reduce debt and other liabilities, such as the pension and retiree health care, but recurring dedicated revenues have the greatest impact. What I also said in that report, and I said in this memo, is that I can't tell you the amount because I don't know what the entire pressures of the budget are. That's an appropriation and Ways and Means discussion about how much do you have and where do you need to deploy it. And I have to tell you that you folks have a heck of a job, the legislators, to make that equation work. And you don't get compensated a lot for doing this work. You don't have great offices, you don't have great staff. If you had them, they'd be great, but you don't have a lot of staff.
We do have great staff.
You have great staff, exactly. We just don't have enough staff. And I guess what I would say to you is that's an incredible job, and I understand that there are more dynamics to that than what I've said. But I do believe, I'm not going to opine on an amount and whether it should be ongoing or one time, although in this analysis, we showed you the different impacts of that. I would say that as you're looking for a solution, and again, this is my opinion, looking at it, recognizing that you folks make the decisions, that revenue has to be a part of it, but certainly not all of it, and certainly not the primary piece of it. You still need to have the structural changes, the risk assessment and risk mitigation going forward, so we don't end up in this place down the road. But I think as you move forward, you have to look at both, you have to have your feet on both sides of the equation. And as I'm thinking about this, I have a little more of a foot, and I'm not sure this is the best analogy, in the structure side, and maybe my toe into the revenue side. But I think that you need to look at both as you're moving forward, and in the context of what's available. What are your options in terms of that availability of dollars? And I just wanted to get that out there, because I know there's been some, Beth thinks we should all have it all done with revenues, or does thinks that you shouldn't do it this way, and others that say, who's Beth? They don't care. But ultimately, you folks are the decision makers there. But I think that looking at the whole solution, recognizing that there are factors both ways, and again, I think that structural changes are necessary to reduce the risk of ending up in this situation down the road. And auditors talk about the likelihood of risk. You can't eliminate risk altogether. So when I hear, so that we're never in this position again. You can have a great recession, you can have unanticipated events, you can have, COVID is certainly an unanticipated event. You can't say there's no way we're ever going to have to look at this again. But what you can do with risk mitigation, with the structural changes, is reduce the likelihood of that. But I did want to clarify my position on that. I think that both are important. I think we need to have structural changes, but I think you should have a conversation about how you deploy either the ongoing or one-time revenues within the context of the larger budgeting process of this state too. I recognize, as I say this, I don't think you should use one-time money in the base. That's a bad move going forward. And Senator White is shaking her head yes, because she's seen that happen before, and the consequence. And we have very prudent fiscal discipline at the by the legislature. And I'm proud of our legislature, and so, by the way, the rating agencies. But I did want to get that out there for discussion as you move forward.
Any questions, comments?
So I do have a question. So Beth, just moving back to funded ratios.
Sure.
I mean, 2038 is still a long time away.
Yep.
And as you mentioned in your testimony, I mean, there are people out there that are concerned that we may be heading into stagflation.
Yes.
And possibly a recession.
Mhm.
If we were to hit a recession similar to the one that we experienced in 2007, 2008, that would dramatically decrease our fund ratios, correct?
Yes.
What would that do to our investments, our investment strategy?
I'm not the investment person,
No, I know.
and by the way, I would like to point out, and you can have Tom in here at some point, they've made a ton of progress. We've made a ton of progress on the restructuring of V. So obviously you have to take a look at your asset allocation. You don't move, for one event, you don't move everything. Some folks reacted, getting out of all the markets, putting it all in cash, and then they didn't get the snapback in 2010. So I think you have to have some discipline in that process, but there's also a retooling of which we do every year, of our asset allocation, and take a look at it. But we did gain something in 2010 by staying the course in some areas. And took advantage of that snapback, because if you look at that chart again, that deep, but then you had that big upward motion after that. And if you put everything in cash, you don't want the buy high, sell low as part of your investment strategy. So waiting it out, which is what you try to do, with your own investments too, is look at that. You might make some changes. One of the things we did consider coming out of the Great Recession, given the low funding position that we were in, is that how much risk can you take? Because you're in a more fragile position. So you might take a more defensive strategy, which means you're giving up some gains to be, so that you don't bottom out. And so that's part of the process. Now, sometimes you can go too far with that. And I'm just going to be candid. I think we did. I think that when you look at it, we were very careful not to put ourselves in a position there when another economic event that you might, frankly, I don't think our systems could have taken that. But maybe as we looked at this, we would have moved a little quicker to retool that. I think we have now, and I think the results speak for themselves. And I have to say that again, Tom Bunker, our chair, our Eric Henry, our CIO, and RVK, our new investment advisor, they're on target on this, and we are going to be doing a much more detailed, as Act 75 asked us to do, in terms of asset liability, and we always do liquidity studies, because another factor, frankly, in 2008 is some folks had so much private debt, so much private equity, so much real estate. And I try not to use the educational institution, but I know that Representative Gannon knows exactly who I'm talking about, as well as other people on the dais here, that they put so much money in that. In fact, they put some of their operating funds into those long-term, and they ended up having to take some of that because they were not liquid enough to pay their retirees. They had to take some of that and sell it essentially on the secondary market to gain cash at a discount to pay for their needed repayments to their retirees, and we never want to be. So we take a look at liquidity as well. So that's the balancing act that happens. I think you do retool, you do look at long-term rates, but you don't, again, I saw folks that said it's gone down from, 10,000 to 7,000. We got to get out now. And that's when you end up with realized losses instead of unrealized, and the opportunity to have some gains in that, as I said, in that setback. I'm not the investment person. If you want to talk about that more, I am fairly decent at numbers and fairly decent in investment portfolios, but the chair, Tom Galanka, is the represents the VPIC, and I would recommend you bring him in.
Thank you. Well, I just have another observation. I mean,
Sure.
I think we need to be careful. I think it's terrific that we had a good investment performance this past fiscal year. Anyone who anticipates that we will have similar performance this year, I think, I would have trouble seeing that.
Yeah. That's why I included the quarterly benchmarks.
Right, and I do think your comment about you can't this problem solely based on investments is accurate.
Yes.
I mean, you just have to look at this chart of investment rate of return since since 1983. I mean, you can see the fluctuations in the market.
Absolutely. Now, at this point in time, we're not in a post-Great Recession. We're right on target and just a tad ahead of those assumptions. That's good news. You don't want to be, I'd love to be ahead of those assumptions, but I certainly don't want to be under. I'd rather be posting gains every year than having losses every year, because we tagged it at 8% or something like that, or 8.5 or 9. I see some systems, if you take a look at the NASRA study, there's some folks that are real outliers. And I think that we're right in the middle now, but we were in range all the way through. But I'd rather be right there in the middle. That median and mean that I showed you tells me that we're in pretty good shape.
But these are unusual times. I mean,
They are.
market performance that we saw last fiscal year was driven in many parts because of the pandemic. We are still in a pandemic right now.
Yeah.
You know, there are things that are impacting the economy that are unusual because of the pandemic. So, I mean, it is hard to predict what's
Absolutely.
going to happen. I mean, we have a huge amount of federal dollars that are in the economy now.
Mhm.
What happens when there is no longer
Yeah.
that money going into the
Yeah.
economy? People are talking about people leaving their jobs. That's leading to stagflation. I mean,
Yeah.
there are a lot of unknowns right now.
Yeah.
So,
I would agree. You take a look at even in the state, the revenue projections, you know, sales tax went way up as people were stocking up, and you have folks that were coming to Vermont and buying the things that they needed. Now we have supply chain issues. You know, I went shopping yesterday, and some of my favorite foods, we won't go into what they are, were not available. And there were signs all over the store that said, you know, that they're doing the best they can, but they're temporarily out of stock. We're seeing this all over the place. And wages. When you take a look at what they have to offer for wages to retain staff, these all are impacts in the, you know, part of the economy. And I tend to be the pessimist when it comes to the economy. I use the analogy, some people see the glass half full, some see it half empty. And I say it's got a hole in the bottom and not holding water at all. But that's probably too extreme. And I have to moderate that and take a look. But I do think we need to take a look at best cases, absolutely, but worst cases too, and make sure that you have downside risk built in, but not so much downside risk because the markets are moving. That's why you're in the market. You're gaining, you know, value in your portfolios, but you need to have some downside risk associated. For instance, real estate is an inflation hedge, things along that line. So you have to have a mix in these things. You're not agreeing with that statement entirely. Yeah.
no, I agree with it in general, but I think, again, real estate has been impacted by the pandemic.
Absolutely, absolutely.
Especially if you're looking at commercial real estate.
Yeah.
It's a very unusual market right now for that.
Sure.
I mean,
I think we're in a good position. We had those same questions, our investment advisor yesterday, that it was our close to all day session on investments. And I think if you want to have that conversation, bring in RVK and Tom Galanka, but we asked the same questions yesterday about real estate and where we were in terms of our portfolio going forward. And those are the kind of questions that investment commission members should be asking. And I think we got the right team to answer those questions as well.
So I just want to offer a comment and a bit of a countervailing perspective. So markets are inherently volatile. There's no doubt about that. Will we achieve 24.6% returns next year? Probably not. But we should mind our risk to the downside. But I would be careful about expecting investment losses as well. I mean, this is an unprecedented time of fiscal stimulus, potentially more fiscal stimulus. What I don't see on the chart in the page is fiscal year to date. Through last week, the S&P 500 returned 6% through the first 4 months of the year. So fiscal year. So, you know, we should be mindful of the risk that's there, but there is also, you know, there is potential to outperform too. I'll say this. I mentioned this to the board when we met, but I was at a conference listening to the chief economist from the Federal Reserve, and someone asked of Atlanta. Someone asked this very question about, you know, the returns from last year. What do you see in the future? And of course, someone from the Federal Reserve is going to be very guarded. But, you know, he gestured to the presentation you just gave on the economic outlook and said, you know, my opinion is these conditions support higher equity valuations. So, you know, I would say let's just be careful about predicting future returns.
Absolutely.
You know, we do have some deferred gains. You know, hopefully we can perform better than our return assumption. Maybe not, but we'll see where that shakes out next June.
No, I would agree. Again, I think that you need to look at your portfolio from a long-term perspective, just as you're looking at those deferred gains right now. The one thing that I want to emphasize again is that this is not you select an interest rate and then the investment committee works around that to try to achieve that. That's not the way we do things. It's about taking a look at what is your risk adjusted return and where do you see your positioning in terms of your asset allocation, but it's not driven by, hey, we got it in the past. You got to get to 9%, so now I'm going to go out and, get some, weird things that I, that get a lot of gain. And, the old adage, if it's too good to be true, looks too good to be true, it probably isn't. You want to have that informed process. And again, the markets are going up over in history, but you also have periods of risk that you need to build into that as well. So that's why you have a diversified, the old don't put all your eggs in one basket kind of thing. So
Absolutely.
I'm doing a lot of those old sayings right now, but I think that, yeah, so hey.
What are some new sayings, Beth?
I don't know because I don't stay in touch with those things, I spend a lot of time on these and not picking up the new lingo, so to speak.
Gotcha.
You
Although
gotta
I-
look on TikTok for that.
A what?
You gotta look.
I was hoping for a to the moon statement in response.
Well, I don't know. I will tell you that when I was a young kid, I wanted to be the first girl astronaut, I said, when I was about 10. Then I realized I get motion sickness. I'm claustrophobic and afraid of heights, so that didn't seem like a good career. So you have to adjust as you move forward.
Right.
Any more questions, comments, observations? Or Beth?
I guess the only last comment I would make is you got a lot of work ahead of you. For me, the time to act is now and not defer this for another year. You really need to come to a conclusion this year. So thank you.
Thank you.
Well, anything you can do to get the actuaries to move a little quicker would be much
Yeah.
appreciated.
We're trying, exactly. They were a little bit behind on ours, and because they had a fairly aggressive schedule. I think they do good work. I think we've got the best actuary team that you can have. I will tell you that our chief actuary on our board was vacationing in Cape Cod, so I ran into her when I was down there, and our lunch was all about actuarial science, so it was really exciting.
What happened to vacation?
That was a vacation. That's the scary part. But they are working to get your materials done. They have to finish what's called the GASB 67, 68 reports. They're doing that now. We expect that they'll be able to change gears really soon. But as we said right out at the onset, that we had to get through those statutory reports and get those done first. But they are going to be able to change gears pretty quickly. So thank you.
Thank you.
Thank you. It is noon. Take a break and come back and look at agenda setting, timing, meeting dates, what we need to hear from. Again, in addition to the actuarial reports, what we expect to hear from. We have been meeting with the judiciary. They'll come in with some kind of presentation. So, okay.
Can I?
Yes.
I don't think we said this, but can I make a suggestion that we stay on target with the agenda that was set and that we have lunch until 1:30?
Oh, wait, I didn't even see that was there. I guess we thought her testimony would take longer, so we wouldn't start till 12:30, but that's fine with me.